Right now, somewhere in the world, a bank just created money. Not printed it, not minted it, just created it out of nothing. And they're going to charge interest on it. This isn't a conspiracy theory. It's not even a secret. It's how the system works. And the strangest part? Most people, including the ones borrowing that money, have no idea it's happening. See, we think of banks as vaults, places where your money sits, safe and waiting. But that's not what they are. Banks are factories, and the product they manufacture is debt disguised as money. Money that didn't exist yesterday, money that won't exist tomorrow if everyone asks for it back at the same time. Let me show you how this works. You walk into a bank. You want $100,000 for a house. The loan officer smiles, checks your credit, types a few things into a computer. Approved. Congratulations. Now here's the question no one asks. Where did that $100,000 come from? You probably assume it came from someone else's deposit, that the bank is just a middleman, moving money from savers to borrowers. That's what it feels like. That's what makes sense. But that's not what happens. When the bank approves your loan, they don't go into a vault. They don't withdraw cash from someone else's account. They open a spreadsheet and type in a number, $100,000. And just like that, it exists in your account, ready to spend. This is called fractional reserve banking, but that name makes it sound more complicated than it is. Here's the simple version. Banks are only required to hold a small fraction of the money they lend out. In the U.S., for most of the last decade, that fraction was 10%. In 2020, it dropped to zero. Zero. That means if a bank has $1 million in deposits, they can legally lend out all of it and then some, because the money they lend doesn't come from deposits. It comes from the act of lending itself. Let's walk through what actually happens. You deposit $10,000 into your checking account. That money is yours. You can spend it whenever you want. The bank promises you that. But the moment you deposit it, the bank also lends it out. Not metaphorically, literally. They lend your $10,000 to someone else. Now there are two people who think they own the same $10,000. You, because it's in your account, and the borrower, because it's in theirs. Both of you can spend it. Both accounts show the balance. $20,000 now exists in the economy, where there used to be 10. But it doesn't stop there. That borrower takes the $10,000 and buys something. The seller deposits it in their bank. That bank now lends it out again. Another $10,000 created. Another loan. Another deposit. Another round. Economists call this the money multiplier effect. It sounds technical, but all it means is that every dollar deposited can become $5, $10, even $20 in the system, depending on how many times it cycles through. And on every single one of those loops, the bank charges interest. Here's where it gets strange. Let's say the bank loans you $100,000 at 5% interest over 30 years. By the time you pay it off, you'll have paid back around $93,000 in interest alone, nearly double the original loan. But remember, that original $100,000 didn't exist until the moment they lent it to you. They created it. And now you're spending the next 30 years of your life working to pay back something that was never real in the first place, plus nearly an equal amount on top of it. The bank risked nothing. They didn't lose anyone's savings. They didn't dip into profits. They manufactured the loan out of thin air, and you're paying them almost $200,000 real dollars for the privilege. And this is legal. Expected. This is the foundation of modern banking. Now, you might be thinking, if banks can just create money whenever they want, why doesn't the whole thing collapse? Good question. It nearly did, multiple times. The system only works if everyone believes in it, if most people never withdraw their deposits at once, if borrowers keep making payments, if the cycle keeps spinning. It's a confidence game, not in the criminal sense, in the literal sense. It runs on confidence. But every so often, that confidence cracks. In 2008, people started defaulting on mortgages. Banks had lent money that didn't exist to people who couldn't pay it back, and then